Well, thanks for tuning into this conversation. From covering the strengthening of India's current account, which is the service and merchandise exports exceeding oil imports, and the last note, build up of the forex reserves, and a lot of macro stuff, and talking about the possibility of the impact on that on equity markets. The Alpha Strategist note for the month of June talks about earnings growth looking good thus far. Now, the authors of the note, when we spoke to them the last time, sounded very confident of earnings growth not only looking good for the preceding 3 years, but looking fairly resolute for FY24 as well. And the opinion out there a couple of months ago was very, very divided. So let's get in Ashish Shanker and Nitin Shanbhag to talk about this month's Alpha Strategist note and kind of let me play the devil's advocate to their beliefs around earnings growth, because if we get earnings growth, then the market is in fine fettle. Gentlemen, thanks so much for joining in. Everybody loves a hat trick, especially the bowlers. Maybe the batsmen don't, but the bowlers do. But I'm sure every market participant would love a hat trick of 3 consecutive years of double-digit earnings growth. And that's how you're starting off. And I presume that's the linchpin on which the optimism around equities stays, Ashish?
Yes, absolutely. And let me say, Niraj, it's always a pleasure interacting with you.
Likewise.
And your viewers. So there are 2 hat tricks here, I must say. This is a hat trick of our interaction on the Alpha Strategist.
Yes.
This is the third interaction we are having. And clearly, as the note suggests, this month, we've seen a hat trick of double-digit earnings growth in the Nifty index. Can you believe this, Niraj, that this has never happened in the history of the Nifty? Even during 2003 and 8, you didn't have 3 consecutive years of double-digit earnings growth.
Interesting.
So it is quite significant from that point of view. So I genuinely believe, and we spoke about this last couple of months as well, I think there is a clear breakout in the fundamentals. Breakout as regards to growth, breakout as regards to the external account, and now we are seeing that breakout in fundamentals in corporate earnings growth. And no wonder that Nifty has been so resilient. And even the next 2 to 3 years look pretty interesting. And if this double-digit earnings growth trajectory sustains for the next couple of years, all of us know here that ultimately prices are slaves of earnings. So we do believe that given the fundamental setup, I think the markets are looking very promising. Of course, you will have there is a major event next year that we have to cross. But I do believe that eventually markets will react to fundamentals. And there, I think we are in fine fettle. And the best part, Niraj, is if you look at this 3 years of double-digit earnings growth, every year you've had different sectors contributing. So you've had metals contributing a couple of years back when you had the entire rally around commodities. Last year was BFSI and auto. And previous year was something else. So I'm saying there is a fairly broad-based recovery. And we've been through the earnings season, quarterly earnings season. If you see the recovery, the earnings growth is not just resilient in the larger companies. In fact, it is far more robust if you go down the pyramid. And we are seeing this probably after almost a decade of very low earnings growth. I mean, if you look at the decade ended 2020, you had a very low earnings growth trajectory. And that we always saw the breakout in fundamentals, but now you're seeing that reflected in corporate profits.
Oh, yeah, and here's this chart that will come up, which is from this note itself, to the point that Ashish was making. So you do the math, but FY8 to FY14, the EPS CAGR was 6.3%, and FY14 to FY22, so 2 years overlap on either side, it was about 7.7. But suffice to say that even if you chuck off, just a safe assumption would be that low single digits, 6-7% earnings growth might be the case. We're seeing 3 years of consecutive double-digit earnings growth. Very likely, viewers, that we might actually get a full over of double-digit earnings growth as well. Just before I talk about the implication of this, Nitin, I want to get you in on this conversation about the... I don't know whether you've done this, but I'm just throwing this out of the blue at you. One is what the Nifty is doing and the Nifty CAGR. 2 is what is the slightly broader end of the market. So I'm not going down all the way to companies beyond the top 500, but let's say the top 200 or thereabouts. Is the earnings CAGR or the earnings commentary and the earnings belief looking strong there as well? Have you been able to do any kind of work there?
We've done some work on that, obviously, and I can tell you that at the larger cap, it is very, very similar, right? And just to add to whatever Ashish said, if we were to break this down in terms of earnings growth, at least in the FY23 bucket, you're seeing that a large portion of it is being led by BFSI, typically banking, right? Now, the same has worked for the top 100 or 200 companies as well. Why is banking so important? Because if you look at most of the commentary that has happened over the last 5 years, between, let's say, FY18 to FY23, most of the analysts have been saying that India Inc. has gone through a massive amount of asset quality cleanup, which has reflected into bank balance sheets. How does that translate into numbers? So at the end of FY18, if you look at the Nifty pool of banking stocks, the profit pool was around 45,000 crores. Today, at the end of FY23, it's grown up 5 times. So 5x in 5 years. It's gone to about 2.1 lakh crores. Similar is the trajectory when you look at the slightly broader space. And when you cast the outlook for banking for the next couple of years, you find that the story remains fairly resilient. So this number of 2.1 odd lakh crores is expected to grow to 3 lakh crores by FY25. Okay. And just to put this into context of the Nifty total earnings at the end of FY20 was about 3.5 lakh crores. So you would have banking by itself contribute almost 90-95% of the total Nifty earnings by FY25. So at a broader level, things pretty much look the same. I think if the Nifty has been driven by BFSI and auto, same has been the case with a slightly broader set of numbers.
Niraj, to come in here, there's one interesting data point in the report which will help put perspective to your question. If you look at the Nifty small cap, right, the last 10-year average P multiple has been 70. Okay. And right now, the trailing multiple of Nifty small cap, if I'm right, is less than 18. Okay. And all of this has happened because of earnings catch up.
Sorry, you're saying it was 7-0.
Yeah, the average P ratio for the Nifty small cap last 10 years was 7-0.
Wow. So it was so highly valued. And now you're saying it's sub 18 or 18.
Sub 18.
Wow.
And one of the biggest reasons for this compression in valuation is because of the earnings catch up.
Yeah. Also, the fact that the index hasn't really done too much, but still, that's a sharp deviation, and earnings growth has to play a part there. Wow.
Absolutely.
Quite amazing. Also, viewers, Nitin, if I understood you correct, there is nearly a 50% growth in the earnings pool of BFSI that you foresee over the next 2 years from where it is at the end of FY23.
That's right.
Wow.
That's
okay.
Right.
Now, let's try and put some numbers to this as well. Again, I'll refer to the chart that you have and then the internals that you guys have spoken about, FY22 to 25. So FY14 to 22, you're saying that the EPS CAGR was 7.7, but the price CAGR was much higher, 12.7. Now, if the belief is that there could be a 15% CAGR, extrapolating what's happened in the very recent past and with the fanfare that India seems to be having, safe assumption that could at the very least be the kind of price CAGR that we could see, maybe even more?
So, look, typically when earnings are growing and at some point, markets start extrapolating that into the future. And we've seen that across cycles. So there is a reasonable possibility that markets could grow faster than the earnings growth. And what's also happening at the, if you look at the internals, right, even the ROEs are increasing. Right, the average ROE of companies, if you just go back 3-4 years, even BFSI space was probably 8 to 10%. Now the ROEs are trending 15% plus. So if you have better ROEs and if your earning setup is looking good, that definitely calls for higher multiples. And the other headwind that you had, rising interest rates, is also now turning into a tailwind. I mean, tailwind in the sense we're not expecting cuts immediately, but at least the clear message from most of the central banks is that we are not going to do any more hikes unless there is clear data to suggest that we should continue to be hawkish.
Got it. Gentlemen, then there is a slide number 8 wherein you are trying to talk, or when you're saying that the business cycle seems to be similar to FY3 to FY08. right? But of course, every cycle has its own winners and losers. Now, I would want to understand that April to March 03 to 08, it was capex, banks, and commodities. Thus far, as you've noticed, it's capex and banks. Do you reckon for this cycle, which could last until 25, 27, who knows, right? But for that, would the set of winners be the same if indeed the business cycle is similar to FY3 to FY08?
So every cycle, as you rightly mentioned, Niraj, has a different set of winners. So maybe the sectors remain the same. At least two of the sectors we believe can continue to drive, that trajectory. Commodities is way too cyclical to call. And we've seen a lot of cyclicality even over the last few years. FY20, you saw commodities. FY21, there was a big rally, and then there was a drop, post that. So very difficult to take a call on commodities, but I would certainly assume that banking for sure. Capex, more driven by PLI. We haven't seen broad-based private capex yet in terms of greenfield projects, but at least whatever has been decided through the PLI is certainly happening. So actually, from a capex perspective, all the three aspects of capex are actually coming together right now, which is your public capex driven by the government, you have private, which is companies, and then you have household capex, which is really real estate. So these three are coming together in a right kind of frame. So I do tend to believe that they will lead the pack of earnings going forward, obviously along with BFSI. And I think the other sector which could do fairly well could be auto. Auto is also coming off a 5-year trend of downgrades in terms of earnings. So FY23 really saw a massive upturn. In fact, if you see calendar year till date, from amongst the top performing stocks, at least 3 to 4 names are within the auto sector. So I do think auto should play a reasonable role, at least over the next couple of years.
Yeah, and the other fact, Niraj, is that balance sheets have got deleveraged over the last 5-6 years. If you see the net leverage, if we do this at a top 500 company level, has come down to 0.5. Which means that the private capex, there is a lot of capacity for companies to do capex, and banks are also really eager to lend again.
Yeah, and that could play a big part too. Yeah, pertinent point. Now, gentlemen, the point about one more point on equities, and the last 3 slides on the equity section talk about this temperature gauge index that you have built out, and you are laying out some emphasis on that, and I believe the predictability of the markets on the back of that. Can you talk a bit about it?
Yeah, sure. So, as against the common price to earnings ratio, which is generally followed by the market, what we've tried to incorporate in the temperature gauge index is also the way interest rates play out over a period of time, and the ratio which is called earnings yield to bond yield, which really shows the attractiveness of the one asset class vis-a-vis the other. As we all know, interest rates act as gravity from a valuation standpoint. So if the lower they go, the higher the valuations, and then vice versa. So when you take all these components together along with price to book as well as dividend yield, you get a very holistic framework which we call as the temperature gauge index. Now, by and large, we've done this study over the last 20 years, and we found that the temperature gauge has been fairly accurate when it comes to looking at what has happened in the Nifty, at least over the next 3 years. So today, as we stand, the temperature gauge index is in the fair value zone. I would, if I remember the numbers right, so up to 125, between the 100 to 125, or between the 95 to 125 is the fair valuation zone from our temperature gauge index value perspective. Beyond that, it is expensive. Lower than that, it is into the cheap zone. The market typically does not spend too much time in either the cheap zone or the expensive zone. So most of the time, it tends to remain in the fair valuation zone. Today, we are at a number of 109, which is fairly considerate, respectable. And despite the fact that the markets look like they are touching all-time highs of 18,700 and beyond, the valuation indicator actually suggests that this current 18,700 is actually a 17,500, right, that we have seen. So I think as earnings growth have progressed, and as they are likely to progress going forward as well, valuations will get a cushion, right? And that really is the fundamental thesis that we are talking about when it comes to deployment.
If you see the table, Niraj, it tells you what is the probability of positive returns and negative returns. So in the fair value zone, the probability of negative returns over the next 3 years is extremely low. And with the kind of tailwinds that we are talking on fundamentals, one can reasonably say that these are good valuations for people to increase equity exposure.
And interestingly, I don't know if this was the same thing that you spoke about the last time, but for new investors, you're talking about, sure, investing in a staggered fashion, but I see multi-cap strategies, select mid and small cap strategies, which clearly shows your bent towards not just investing or focusing towards safety net of the large caps, but taking a little bit of risk with the broader end of the spectrum.
Yeah, see, typically what happens is when you get a cycle of good earnings and the broader market earnings we just discussed. So the broader market always tends to do better. Even if you look at 2003 to 8, small caps did better than mid caps did better than large caps. So we feel that a similar kind of scenario is likely to play out. And hence, we are now suggesting that people could take a little higher exposure to broader markets. Last 18 months was a consolidation, and if you see, the large caps kind of did much better. But what has happened in the last 18 months is earnings have also caught up, and the valuations actually in the broader markets have become much cheaper.
Okay. Now, just a small point out here, and no one can blame you for putting in the assumption around the US Fed rate expectations the way you did, because what the Fed has done overnight is out of the blue, so to say. Now, my question is, if indeed, I do think that the Fed is still data dependent, but if indeed what Jerome Powell said about no rate cuts, at least until the next 24 months, turns out to be true, does this negate in any fashion any kind of equity expectations or even the fixed income assumptions that you have made for your clients, and that my viewers would want to really know about?
Yeah, please.
So basically, the way we see trajectory of interest rates is that given the parity of rate differential, which has really reduced over the last 12 to 18 months between the US rate and India, we do not see RBI resorting to any rate cuts immediately, which means even in India, you'll probably see the yield curve staying flat for a longer period of time. And yields should sustain because currently liquidity has also come off quite a significant amount. So the short-term rate, if you look at the 1 year, is around 6.8, 6.9, and the 10-year GSEC is at about 7%. We believe this is likely to continue going into next year as well. But having said that, I think the equity market should not trend reverse to what has happened so far.
Sure.
Because in many ways, cost of capital without actually interest rates coming down is reducing for quality companies, at least over the last few months or so. So I don't think that can cast any negative aspiration as far as the equity markets in India at least are concerned.
Fixed income assumptions, Nitin, very quickly.
So we continue to believe that the sweet spot lies in the 3 to 7 year kind of segment. Like I said, yields are fairly stable, they are flat, and for that kind of accrual, if you're getting close to 7 to 7.5%, be it GSEC or AAA corporates, I think that's a fair yield to get. But at the same time, what we have, as you remember, Niraj, we had suggested about a couple of months ago, we are actually talking about multi-asset solutions to be a key portion of your fixed income portfolio. Without which it will be relatively tougher for you to beat inflation at a post-tax level consistently, right? Inflation obviously has come off. The last print came at around 4.7. But if I take a longer-term trajectory, I would assume that simply being into AAA and GSEC may not produce the right results from a debt portfolio. You need to have multi-asset solutions. So equity savings funds, what we spoke about, or certain other, you combine REITs, you combine InvITs, and certain other high yield kind of products. I think that will give a good portfolio overview over the next few years.
And viewers, I'm skipping gold per se, but remember, they'd spoken about gold for the last 2 months. 2 tranches of sovereign gold bond, a fresh issuance is coming up, so you may want to look out for that. Ashish, my final question to you, because you guys have a great pulse of what the HNI investor in India might be doing. You might have a great sense of what global investors are doing when it comes to India. I've been talking to a lot of domestic fund managers who are reaching out to global investors and they're getting great response. I would love to understand from you, Ashish, what do you think is happening within the rich of India as well as global funds? Are they getting, is Indian equity looking tremendously attractive? Are they looking at some other options in a meaningful way if indeed Indian equity is looking so attractive? Tell us a bit about what the pulse of the market seems to be, or the pulse of the investor is.
So I think, we talk to HNI investors a lot, HNIs, ultra HNIs, family offices. And the last few months, there has been a lot of interest on structured debt. Reason being that after yields went up last year, debt yields suddenly became extremely attractive. And if you see, there has been a lot of volatility in equities over the last 18 months. So there has been a lot of participation in debt, and that too within debt, high yield debt, structured debt. So we have seen a lot of flows coming into those kind of funds, products, or even direct bonds. Equities somewhere, I think there is a bit of a missed out feeling as we speak. Suddenly the markets have run up and we are closer to all-time highs, but we've been at these levels for a while now. So over the last month or so, we're suddenly seeing a lot of activity because all the portfolios where allocations were to be made in equities or probably increased, suddenly there is a lot of interest and activity to increase equity allocations. The other part of what global investors are thinking, we have a very active institutional equities desk, and many of them travel to Hong Kong, Singapore to talk to foreign investors. So at least there is a clear view that India, from a growth and from a corporate earnings point of view, is the most attractive destination as we speak, right? There were challenges. There were different challenges for foreign investors. You had the Fed hiking rates, and you had bank failures in the US, and there was generally a little bit of wait and watch approach when it came to allocations. And it is not just India allocations; it's more to do with global equity allocations and emerging markets, right? Now, over the last couple of months, I think people are relooking at equity allocations, especially in emerging markets. And we do believe that whenever funds come in, India should get a slightly disproportionate share of those flows. Because if you look at the market cap and the contribution of GDP to global GDP, China is the only other big market. And the kind of challenges China has had, especially on capital markets. So whenever flows come back, I think we will get a disproportionate share of the flows. So I'm just feeling that, you're going to see a glut and a culmination of HNIs coming back and foreign investors coming back. So that's one of the reasons why I told you at the beginning that I would be scared to be out of markets, in the sense that whatever allocations you prefer to make in your portfolio, you should get done with it.
Wow. And this is on a day when the India market capitalization of the BSE has hit a record high. And the month of May has seen significant inflows already from global investors. Gentlemen, both of you, thank you so much for spending time with us, writing a very interesting note and talking about it with our viewers. Much appreciated.
Yeah, thanks, Niraj.
Thank you.
Pleasure.
Thank you so much.
The pleasure is ours. And viewers, thanks for tuning into this conversation.